Hello, everyone. I'm Bob Goulder, contributing editor with Tax Notes. Welcome to the September edition of In the Pages, where we take a closer look at some of the commentary that appears in our print and online publications. Today, we're going to be talking about the so-called Wyden plan, which is a reference to the chairman of the Senate Finance Committee, Senator Ron Wyden from Oregon. He, of course, issued a discussion draft in late August, together with two other members of that committee, Senator Mark Warner from Virginia and Sherrod Brown from Ohio. If enacted, the proposals would radically change some of the international provisions that were adopted as part of the Tax Cut and Jobs Act 4 years ago. Now, the notable thing here is that these proposals, they clash, quite frankly, with what the Biden administration and the Treasury Department are also proposing. To help us make sense of all of this, we've called in the assistance of one of our very favorite outside contributing authors, a man who really needs no introduction to anyone who's been reading tax notes for any length of time. He is Professor Reuven S. Avi-Yonah from the University of Michigan Law School. He's the author of our featured article for the month, which is entitled Gucci Gulch Redo, the Problems with the Wyden Proposal. Professor, thank you for joining us.
Thank you for having me.
And I suppose before we get to the meat of the discussion, we should clarify the reference in your headline, Gucci Gulch. We both know what that means, and especially down here in Washington, D.C., it's well understood that it refers to the profession of lobbying and all these tax lobbyists who exert a high degree of influence over our legislative process. Of course, it's also was in the title of the great book, perhaps the definitive book on the 1986 Tax Reform Act, Showdown at Gucci Gulch. Now, Professor, I have to ask you, the fact that you've referred a reference to Gucci Gulch in the headline of our featured article, that strongly suggests to me that you suspect that lobbying has been going on.
I suspect lobbying has been going on. In fact, I think it's going on as we speak. And I'm sure lobbying was going on also when the TCJA was enacted, except that it seems to be a little bit, the process seems to be a little bit more transparent this time than last time. At least my recollection is 4 years ago, it was pretty opaque. No, open markup and all of that sort of stuff.
Okay, so the featured article, as I mentioned, Gucci Gulch Redo. Now, this is actually not the first time you've written about the Wyden proposal. You wrote about it in Tax Notes back in April, and at the time, you likened some of the provisions there. You actually likened them to some of the Bush-era tax proposals of the early 2000s, which is a little bit odd since Wyden is a Democratic senator and Bush was a Republican administration. But here's one of the big takeaways from your piece. You're saying that since the spring, given the new information that we have about the Wyden proposals, you write that you think they've actually gotten worse. So that's what I would really like to spend our time today talking about, your description of these problems with the Wyden proposal. And I think we should just start with the guilty provisions, okay? And most people know what the Treasury wants to do with guilty. How do the Wyden proposals differ, and why are they worse than what the administration's proposing?
So there are several differences, but the main one is really that instead of doing a guilty on a country-by-country basis, which is what the administration has proposed, which is designed to prevent the temptation to shift income out of the United States into low tax jurisdictions in order to average them with high tax jurisdictions overseas. And that, there's a long history of that goes, back to the various baskets that we had in the 86 Act, and per country we had before the 86 Act for the foreign tax credit purposes and so on. So this is not new. What the Wyden proposal does instead is that it has this high tax exclusion. And the high tax exclusion is really taken over from something that the Trump Treasury gave to the multinationals with no basis in the statute, which is to apply the Subpart F high tax exception to guilty. And I was really surprised that the Democratic senator would take over something that was done by the Trump Treasury, and they even referred to it explicitly. So there's no question that that was the source, and insert it into his proposal. And there are other problems with this particular item. The main one, I think, the thing that bothers me the most is enshrines in the tax code the exemption for some sort of foreign source income. For 100 years, from 1918 until 2018, we had from whatever source derived, US persons were taxed on all of their income. And then, of course, in 2017, we got a participation exemption through this mechanism of the QBI. Now, Wyden and the White House want to get rid of the QBI and the qualified business exemption, but for once you have a high tax exclusion, like the Wyden proposal does, you keep an amount that is totally exempt, which the Biden administration proposal does not. And I think that's problematic because I don't care that much about rates. Rates go up, rates go down, but it's the structure that I mind. And this is a structural defect.
Now, you mentioned that we also have a high tax exemption for subpart F. And I suppose the supporters of the Wyden proposal would say, wouldn't it be nice to have some kind of symmetry between guilty and subpart F? But that just leaves me scratching my head wondering, why do you need to do that? You've got guilty, you've got subpart F, they're different regimes, because one has a high tax exemption, why does the other one have to as well? Does that sort of conformity get us anything in terms of policy?
I don't think so. I mean, first of all, about subpart F has many, many problems derived primarily from the fact that it's really old. Subpart F dates to 1962, including the high tax exception and various of its other provisions, the dividends and all on the rest of it. And most other countries, I mean, there are now more than 30 countries that have so-called CFC rules. Subpart F was the first, and they learned from our experience that they did things significantly better along the lines of what the OECD is proposing now, that is primarily taking the foreign tax rate into account, not just when it's too high, but also when it's too low, a minimum tax approach. And that's essentially, to some extent, what guilty does with the way it is with foreign tax rate and so on. Guilty has a significantly better regime than subpart F, so I don't see any reason why guilty should conform with subpart F. In fact, I think it is plausible to argue, especially with a revised guilty that doesn't have QBI, that we might as well just repeal subpart F. One thing that I don't understand is why it is that every time we add something to the code, we never delete anything that essentially is redundant. And that's just an invitation for game playing. I mean, the use of the high tax exception in subpart F into guilty was something that clearly was not intended. And had we deleted subpart F when we adopted guilty, that wouldn't have been on the table.
So these regulations that came out last summer when the Treasury Department was under different management, they really don't have any authority in the statute for doing what they did. I mean, you would think that if there were to be a challenge, that those regulations would be vulnerable. But rather than challenge them in any type of a judicial proceeding, the path of least resistance might just be for the Biden administration to revoke those regulations. And it's just so strange to me that you have a Democratic administration that opposes this, and Democratic senators that basically want to embrace that concept. I guess it does go back to your point about the lobbying. Now, if I were to try to sit here and defend the high tax exemption to you, which I'm not sure that's really where my heart is, but if I wanted to do that based on the speaking points that are out there, the defenders of it, they come back to these two items. They say that doing country by country approach here for applying guilty is just too complicated, that it's going to be too burdensome on companies, and that it's just going to be bogged down by complexity. And the other thing they say is that a high tax kickout can be just as effective at limiting profit shifting. Now, having read your article a few times, I'm not sure you buy those arguments. Would you like to respond?
I don't. I mean, first, on the complexity front, I mean, this is very reminiscent of what was done, in fact, in Gucci-Galci in '86, because what the Reagan Treasury proposed was to do both baskets and per country. We used to have per country, and they said the problem is within the same country, you can have high tax and low tax income, so let's superimpose baskets on the per country. And the multinationals all said, oh, this is way too complicated. So they dropped per country and just kept the baskets. We are talking about super sophisticated taxpayers with endless tax advice and a lot of money to spend on it. Do we really believe that this is too complicated to do country by country, especially since we've had country by country for foreign tax credit purposes for many, many decades before 1986. So there's no real complexity here. In addition, high tax involves its own complexity. In fact, if you just compare the Wyden proposal to the Wyden proposal is significantly more complicated because of the high tax exclusion. It has to do with branches, has to do with losses, has to do with timing. There are all kinds of issues that arise because of that. And then finally, the point that if they're both the same, why not just adopt that one? Well, A, they're not the same because this is much more complicated. And B, I think they're also not the same because I think the moment you have something like high tax, that can be gamed. And in fact, it can be gamed in the same way that the high tax exception from Subpart F was gamed. And the problem is basically this. The amount of tax that you pay to the foreign country is determined by the foreign country. But the base for calculating the effective tax rate is calculated based on US principles. I mean, Supreme Court said so. And once it's calculated based on Supreme Court principle, it's possible to create deductions, for example, that the United States will see that the foreign country does not see, such as, for example, instruments that we treated as debt and the foreign country treats as equity, so therefore they don't allow the deduction for dividends. So you can create artificially high tax environments, and that then invites shifting because the amount is exempt and so on. So I really don't think that that's the way to go.
Before we leave the topic of GILTI, I wanted to get your thoughts on the carve out for QBI, qualified business asset investments. And this might be one area where the administration and Senator Wyden have some agreement. When I think about QBI and I try to rationalize it, it always seems like they're trying to limit the scope of the pool of foreign income that the GILTI rules apply to. And you can phrase that in different ways. You can kind of separate routine profits from residual profits, or normal profits from excess profits, or profits derived from tangibles versus profits derived from intangibles. The question that I'd like to ask you as a policy matter, is there really a legitimate basis for having that narrowing? In other words, why not just have GILTI apply across the board to all foreign income? Why do we need QBI?
I mean, I think we don't. And in fact, that's one thing, as you point out, that the administration and Senator Wyden agrees with. Unfortunately, Chairman Neal takes the other view, as we have now seen. But I really hope that they will get rid of QBI because, as everybody has pointed out since TCJA, this is simply an invitation to move factories and jobs overseas because it's based on tangible assets. And that's the last thing we want to do. So that's the thing that the Democrats unanimously criticize TCJA for. And why should we leave that in?
At one point in your article, you make an expression of sort of a personal preference about the U.S. rate structure. You write, and it's sort of what we would call, if it were a court opinion, we would call it dicta. You know, it wasn't your main case against the Wyden proposal. It was just sort of concurrent thoughts. You said you wouldn't necessarily have a problem if the rate on foreign profits and the rate on domestic profits more or less matched. And you even said, say they were somewhere around 25%, which happens to be roughly the OECD average. If memory serves me correctly, it was also sort of the standard rate that Chairman Camp floated in his proposals going back a few years ago now. That got me thinking also, because the proponents of this concept, capital import neutrality, they argue that you have to have something like GILTI with a reduced rate, because you have to tax foreign profits at a lower rate than domestic profits, because otherwise you'll lose competitiveness. Is that really so? What are your thoughts on that?
So I never bought into that for a whole variety of reasons. First of all, the big advantage of having the same rate is that then you really can get rid of outbound transfer pricing. And the vast majority of our transfer pricing cases, which are really complicated and really expensive for the IRS to litigate, is outbound, not inbound. I mean, Facebook, Coca-Cola, I mean, all of this stuff think about all the resources we would save if we equalize the rates, because of course transfer pricing is all about exploiting rate differentials. But the fundamental problem with this competitiveness argument is there are several problems. First of all, why would you really think that competitiveness depends just on the foreign rate as opposed to the overall effective rate of the multinational? I would think that the competitiveness of American multinationals depend on the total rate that they pay on all of their income. That's what they report to shareholders and so on, and how that compares with foreign rates. Now, I did some empirical work before TCJA and showed that the top 100 EU multinationals had the same rate basically as the top 100 American multinationals, even though we had allegedly worldwide and they had allegedly territoriality, because of course our worldwide was not real and so on. And I think it's the same now. I mean, if you adopt a reasonable rate, say 25, as I suggested, there's no reason. I mean, Germany, for example, has 30, and they have more robust CFC rules than we do. So I think that's point number one. Point number two, what's the evidence that American multinationals lack competitiveness? They were super competitive before TCJA, they're super competitive now. If you look at the list of the top multinationals in the world, they're really dominated by the Americans, just like they were in the 60s. I mean, there was a period in between that there was more competition, but now, you know, you could say the main competition is in China, but the big Chinese digital giants are really only in China. They're not competitive yet with Facebook, Google, Amazon, et cetera, et cetera, et cetera. I mean, we're kind of the champions of the world, so I don't see what's the evidence for that. And finally, this kind of ignores the fact that we're now well into a process in the OECD of making sure that there's a level playing field and that there'll be a minimum tax that applies to everybody. And because of that, I think it's really important what rate we choose, because then we can argue to ratchet the OECD process a little bit up, not 15, but let's say 21.
Okay, now I wanted to move on to the FDII regime. Supporters say that you need something like FDII to incentivize innovation, the development of high value intangibles, whether it's something from a tech company or something from a pharmaceutical, the types of intangibles that have been migrating overseas to foreign patent boxes for many years. When people present that case for FDII, they say, well, we need something like that. Okay, but not everyone's comfortable with how FDII is structured. So my reading is that the Biden administration would just get rid of it altogether. Whereas the proposal coming out of the Senate Finance Committee with Senators Wyden, Brown, and Warner, they would really kind of keep it, but replace it with some sort of an enhanced R&D incentive. And that gets me thinking, well, don't we already have rewards in the system for R&D? What's your view on these divergent views on FDII?
We certainly have rewards for R&D. And first of all, R&D is expensed, right? I mean, you know, based on normal ideas, if you do something that generates future income, then it's really supposed to be capitalized and not expensed. Second of all, R&D notoriously, you can have R&D that's conducted in the United States and all the income is generated overseas, and they allow you to deduct it from US income rather than foreign income, as it's supposed to be under normal, the way we allocate and apportion deductions. And then finally, I really don't see the point of having something like FDII in particular, because unfortunately, both what is suggested here, and I think what other suggestions have been made, all keep the main flaw of FDII, in my opinion. And the main flaw of FDII is simply that it's export contingent. And because it's export contingent, it's a blatant violation of the WTO rules. And so we really open ourselves up to the EU suing us, and then there's sanctions, and then we have to, you know, if you go back enough, you know, first there was the DISC, and then there was the FISC, and then there was the ETI. We had, you know, decades of this fight with the EU. And then finally, in 2004, we abolished it because we had to, because they put sanctions on us, and they taxed Florida oranges in an election year, right? So then we abolished it, and we had the now deleted 199 instead, which was not export contingent. And here we go back, and we have export contingency, which the Republicans put back in. And now we're going to keep that. That makes no sense to me.
Yeah, so I hear people complain, though, that they say that the member states of the European Union have VAT regimes that include border adjustments, and they look at that and they get quite envious. They think that's a export contingent tax break, but that's an indirect system, right? The WTO rules allow you to do that through an indirect system, but FDII is a direct tax system. So it looks like it would be a violation of WTO rules.
Right. And, we could certainly adopt our own VAT. In fact, I think eventually we'll have no choice, but that's not on the table at the moment.
Yeah, the U.S. value-added tax will be a topic for another interview with you when we get there. But let's talk about BEAT real quickly, because we talked about GILTI and we talked about FDII. We wanted to talk about BEAT. The administration wants to just replace it with this new regime called the SHIELD. And Wyden again has sort of a different take that does not comply with what the administration has. Can you briefly explain why the BEAT proposal coming out of the Senate Finance Committee might not be desirable?
And the BEAT proposal is less developed in the Wyden proposal than the other ones, and they say that they might add more elements to be taken over from SHIELD. So maybe some kind of compromise can be reached. One thing that is missing from the Wyden proposal that's in the administration proposal is SHIELD. The beginning stands for Stop Harmful Inversions. There's nothing about inversions in the Wyden proposal, and that's a problem, because if you increase the GILTI rate, the one way that you can get out of all of this is by inverting, and you really need to do something about that, in my opinion. And then there are other issues. I mean, BEAT has many problems in it, and it's not clear that this fixes it. So the fact that cost of goods sold is not included, the whole thing that the Trump Treasury did with the cost services method and not applying it to the whole amount, but only to the markup. BEAT was estimated to raise a lot of money back in 2017, and it has raised much, much less than that. So obviously problems with the BEAT that need to be fixed. And I'm not sure that this does it. I'm not sure. I mean, as I understand SHIELD, because it's also contingent on the minimum tax rate in the other jurisdiction, it will solve one of the big problems with BEAT. Actually, it goes in the opposite direction, which is that BEAT does not have a foreign tax credit element in it. That's something that Wyden wants to put back in. I think with SHIELD, you don't need to do it to some extent, because SHIELD would not operate if there's a significant foreign tax, which is, I think, actually the way BEAT was supposed to operate to begin with.
Any discussion of all of these changes has to be done with this idea in mind that the OECD is having discussions at the multilateral level. And I have a question in my mind about who's waiting for whom. Is the OECD and Pascal Sanemans and the people over there in Paris, are they sort of waiting to see what happens domestically in the US with GILTI, which is basically an income inclusion rule, and with BEAT or SHIELD, which is basically like an undertaxed payment rule? Because that looks a lot like the US version of Pillar 2 right there. So are they waiting for us to act, or is it the flip? Are we waiting for the OECD to come out with like the next variation of a blueprint to give us some indication about what the countries of the inclusive framework are coming up with? Who's waiting for who?
So, I mean, you could say both sides are waiting for the other one, but I think when the Biden administration put out its proposal in the Green Book, they thought that more likely the OECD will finish first. And the OECD now has, as far as I understand, a firm deadline of finishing by October. And the SHIELD, for example, hinges on the OECD Pillar 2 being in place in order to work. But Congress works differently, and my understanding is that we're now in a rush to finish everything even before the OECD, and therefore I think it will go the other way. That is, if we succeed in passing this, then it will be a basis for what the OECD does, and this is why I really would like the GILTI rate to be as high as possible, and not 16.5 like Neil proposed, for example, because that will push the OECD, in my view, in the right direction.
Okay, one last question, Professor, and it has nothing to do with GILTI or FDII or the BEAT or the SHIELD. It's really just about politics. You can't help but notice that these are all Democratic lawmakers, even if you bring in Representative Neal from the House Ways and Means with what's just happened recently. It seems they're all pushing back against the Biden administration. In some ways, it almost looks like they're doing the Republicans' bidding for them. Why do you think that is?
That's a tough question. I don't know. And I'm a tax expert. Politics is not my business. I've never actually held a position in Washington, luckily. But obviously, lobbying may be one part of it. The high tax exclusion, because it's taken from something that the Trump Treasury did, I suspect of being lobbied. There's other stuff, though, that may be going on. So, for example, Senator Wyden, whom I greatly respect, has other proposals that he introduced by himself, such as the mark-to-market proposal, and now the new partnership tax proposal. Senator Brown has this excise tax on stock buybacks proposal, all of which I wholly approve of. Whether any of that will make it into the final package, who knows? These are proposals that they introduced kind of more in their personal capacity. I suspect that what's going on is simply that in order to get everybody on board, you need to modify what the administration wanted. That happened in TCJA also notoriously, and you need to get something that will pass. By far, beyond everything else, I think I and everybody else, including the administration, want to get the package through, because unless you get it through, the whole $3.5 trillion thing collapses, and that is the main agenda of the administration. So I think even the administration would not object to compromising on some of these things in order to make sure that something passes. And you need the political constraint is that you only have 3 votes in the House and 0 votes to spare in the Senate. So you need everybody to go along, which is why it's important that Wyden teamed up with Brown, who's a progressive, and with Warner, who's considered to be more moderate, in order to introduce this proposal.
That makes perfect sense when you describe it in those terms. Professor, thank you again for joining us. There's a link to your article in the description below the video. And it's a great article. Again, Gucci Golf Redo, the problems with the Wyden proposal. Read it in tax notes, and stay tuned. We'll have more of these coming in the following months. Thank you very much, Professor.
Thank you.
Want more like this? Subscribe for more tax videos. Special thanks to our executive producers, Jasper Smith and Paige Jones, and showrunner and video editor, Jordan Parrish.